Hello guys, welcome to another video from Gen Z Wall Street Millennials. In this episode, we will be looking into how Peter Thiel grew a $2,000 investment back in 1999 into $5 billion today. Peter is no stranger to controversy, from wanting to live for a century to his role in the PayPal mafia. Thiel makes an exciting case study on how to become ultra-wealthy through investing. Let's get started. The year is 1999. Peter Thiel, a Stanford law graduate, ran a small hedge fund and hadn't yet joined the ranks of the ultra-wealthy. But he had outsized ambitions for his months-old tech venture, where he served as both chairman and CEO. He envisioned his company creating a new world currency, free from all government control. Later that year, a deputy of Thiel's at the company that would become PayPal walked into the San Francisco office of Pensco Pension Services. It could have been an uneventful appointment. Instead, it changed Thiel's life. Pensco was a small firm that allowed its customers to put nearly any investment they wanted into a tax-advantaged retirement account. Thiel was about to become Pensco's whale. Influenced by libertarian Ayn Rand and Tolkien's fantasy trilogy, Thiel, then in his early 30s, carried himself like a contrarian philosopher king. A few years earlier, he had co-authored a Jeremiad against multiculturalism that accused the administration of then-President Bill Clinton of waging class warfare. Taxing the rich seems to have become an end in itself, he and his co-author wrote. Pensco founder Tom Anderson recalled how Thiel and other PayPal executives had wanted to put startup shares of the company into 401ks. Anderson dangled something sweeter. I said, if you really think this is going to be big, you might want to consider this new Roth. If the investment ballooned, he remembered saying, you're not going to pay tax on it when you take it out. It's a no-brainer. The math was compelling. Thiel wouldn't get a tax break up front, but he'd avoid an immense tax bill later on if the investment surged in value. They immediately grasped that, Anderson said. And they did it. What happened next deprived the US government of untold millions in tax revenue. Perhaps billions. Thiel used his new Roth IRA to purchase shares of his startup. In 1999, single taxpayers were allowed to contribute to a Roth if they made less than $110,000. PayPal offered its top executives low initial salaries and large stock grants. Thiel's income that year was $73,263. Americans with IRAs use them to purchase publicly traded stocks, bonds, mutual funds and CDs. Thiel bought shares of a private company, whose value wasn't tied to the stock market. Thiel's financial assistant disclosed in a letter included in the entrepreneur's application for residency in New Zealand, Mr. Thiel purchased his founder's shares in PayPal through his Roth IRA during PayPal's formation. He bought his first slice of the company in January 1999. Thiel paid $0.001 per share for 1.7 million shares. He was able to buy a large stake for just $1,700. In 1999, $2,000 was the maximum amount you could put into a Roth in a year. Thiel's unusual stock purchase risked running afoul of rules designed to prevent IRAs from becoming illegal tax shelters. Investors aren't allowed to buy assets for less than their true value through an IRA. The practice known as stuffing gets around the strict limits imposed by Congress. At the time Thiel bought his founder's shares, his own hedge fund had already loaned the new startup $100,000, California and SEC records show. And soon after the company sold him the shares, millions of dollars poured in from investors. The company sold a slice of itself to investors for $500,000. Another $4.5 million poured in from the venture fund arm of telecom giant Nokia and other investors. The dot-com boom was in full swing. We're definitely onto something big, Thiel told employees in late 1999, predicting that PayPal would become the Microsoft of payments, according to The PayPal Wars, a book by a former employee recounting those heady early years. But when it came time for Pensco, the custodian of Thiel's Roth, to report the value of the account to the IRS at the close of 1999, none of the investor enthusiasm was apparent. Pensco told the IRS that Thiel's Roth was worth just $1,664 at the end of 1999, tax records show. From there, nothing would stop Thiel's Roth. In a Silicon Valley equivalent of Tolkien alchemy, his Roth would transform those PayPal shares into a tax-free fortune, one that would be safer than all the gems, gold and silver in the Dragon Smog's mountain. Thiel would never again contribute money to his Roth. He didn't need to. In just a year's time, the value of his Roth jumped from $1,664 to $3.8 million. eBay purchased PayPal, Thiel sold the shares inside his Roth, his financial assistant later told New Zealand officials. The tax-free proceeds poured into his account. By the end of 2002, Thiel's Roth was worth $28.5 million. If he had held his shares outside of the Roth in a normal investment account, Thiel would have owed the IRS 20% of his gains and owed another 9% to California tax authorities. Because the shares were in a Roth, he had no tax bill when he sold them, saving him millions. This strategy is similar to a grantor-retained annuity trust used by Mark Zuckerberg before Facebook went public. Additionally, Fred Trump, the father to Donald Trump, used a GRAT to transfer his real estate portfolio to his heirs. By undervaluing the real estate portfolio for tax purposes, then placing it into the GRAT, Fred transferred rental apartments to his children. The whole idea is to place an asset in a tax-free or tax-deferrable structure, then lowball the value of the asset for tax purposes. By taking these precautions, the asset can grow tax-free as well as explosively. Year later, the beneficiary can sell or transfer ownership to himself or the next generation. High cash value life insurance policies also deserve an honorable mention. Thiel had an advantage few investors could claim: his own personal investment bank not subject to taxation. He could now use the cash inside the Roth to buy and sell nearly any investment he wanted. Thiel used the millions in proceeds from his PayPal windfall to invest in other Silicon Valley startups as well as his own hedge fund. He scooped up startup shares at bargain basement prices. Thiel and colleagues in 2003 founded Palantir, a data analytics company, helped by an early investment from a CIA-backed venture fund. The company was named after the seeing stones made by elves in The Lord of the Rings. Thiel used his Roth to buy shares of Palantir when it was still a private company, years before it was listed on the New York Stock Exchange. Over the years, Palantir has won federal contracts from the military to hunt terrorists and from U.S. Immigration and Customs Enforcement to find undocumented immigrants. Even the IRS has a $99 million contract with Palantir to comb through data to identify tax cheats. But wait, there's more. Yes, in 2004, Thiel met Mark Zuckerberg, a Harvard undergraduate who had come to Silicon Valley. Thiel invested $500,000, Facebook's first large outside infusion of cash. Those Facebook shares ended up, where else? In Thiel's Roth IRA, an attorney for Facebook later disclosed in a letter filed in federal court. That ensured that Thiel wouldn't owe taxes on his early investment in the company. Thiel's Roth reached new heights, reflecting Facebook's meteoric rise. In his best-selling book, 0 to 1, Thiel wrote, "Money makes money." By the end of 2008, the Roth was worth $870 million. A secret of Thiel's is that his fortune was built on massive tax breaks. By 2019, Thiel's holdings had grown so vast and diverse that his $5 billion was spread across 96 sub-accounts inside his Roth. As his wealth grew, Thiel showered millions of dollars on Republican politicians and groups with an anti-tax agenda. In 2016, he became the rare Silicon Valley titan to endorse Donald Trump. The Trump years, which fueled a market boom, were good for Thiel and his Roth. In 2018, he moved his Roth from Pensco to Rivendell, the family trust company named after Tolkien's elven sanctuary. In Tolkien's fantasy world, elves can be killed in battle or succumb to grief, but they don't die of old age or disease. Thiel has told people he hopes to live to be 120 years old. That might be a bit optimistic, but he is not taking any chances and is investing in anti-aging technology companies. He's even tucked some of those shares into his Roth, SEC and tax records show. Assuming a modest 6% annual return and no withdrawals, his tax-free golden egg could be worth about $263 billion in 2087, when Thiel plans to celebrate his 120th birthday. That's larger than the current gross domestic product of New Zealand, his adopted homeland. So there you have it, guys. What do you think about Peter's use of the Roth IRA? What do you think about tax planning and tax avoidance? I would love to hear your comments below. Cheers guys, see you in the next one. Gen Z Wall Street Millennial signing out.